QuickBooks Online 2025, entering deposits. Deposits from an owner investing money into the business, deposits from a loan taken out from the bank. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 project file we set up in a prior presentation. We're going to be opening up our major financial statement reports as we do every time. The reports on the left-hand side in the Standards tab under the Favorites. There's our balance sheet. Right-clicking on it to open the link in a new tab. Right-click in the profit and loss, also opening a link in a new tab. Let's tab to the right. I'm going to close up the hamburger. Now, we entered our data in a prior presentation as of the cutoff, 12/31/2024. Now we're going to be doing data input in the current accounting period, the current accounting year, in our case, 2025. Therefore, I'm going to run the date range for the year of 2025, going from 01/01/25 to 12/31/25, and then just run it to refresh it. There we have it. Let's tab to the right and repeat the process. Closing up the hamburger. We're going to go from 01/01/25 to 12/31/25, and then run it to refresh it. The point being here that there's nothing in the profit and loss, and on the balance sheet, we just have those beginning balances that we entered in the prior accounting system. Now, although we have imagined that we're picking up the beginning balances from a prior accounting system, which means that we were in business to some extent before starting this new accounting system, we want to start now by thinking about those types of transactions that are unique to starting or growing the business, those transactions related to needing the money to first basically get started. So in other words, if you have a new business that you're going to be setting up, then first, of course, you're going to have to get the business up and running. We've been talking about getting the QuickBooks file up and running, but now we want to think about the transactions that will be recorded to get the business up and running before we can start the day-to-day transactions, the day-to-day type of sales transactions. So just to get an idea of that, let's first look at the balance sheet. We have our assets, liabilities, and equity here. The assets represent what the company has in order to help generate revenue in the future. That's why the assets are there. Even the cash in the business is there because we're expecting to consume it in the future to generate revenue. If that wasn't the case, we wouldn't have the assets in the business. We would sell them and give the money to the owner in the form of a dividend if it was a corporation, or just a draw if it was a sole proprietorship. So the asset represents what the company or the business is holding in order to help us generate revenue. The liabilities represent third-party claims to those assets, typically from the bank and possibly to vendors, the smaller balance usually to vendors that we purchase things from that have not yet paid them. The equity then being the book value. In other words, we can reformat this accounting equation as assets minus liability equals equity, the book value of the business, or in other words, the owner's claim, whether that be a sole proprietorship, multiple partners, or multiple shareholders in a form of a corporation, their claim to the assets of the business. Now, when we're starting up a new business, then we're often going to need startup capital for the business. We need some money. Why do we need the money? Because a lot of businesses have startup costs. Some do not. Like, for example, if you're going to become a YouTuber or something like that, you have very small startup costs compared to other types of business. You can basically use your phone these days in order to start the YouTube channel. So that's great because you're not going to have a lot of these startup costs. You're not going to have to generate capital in order to break into the market because you have a little amount of capital in order to do that. Now, there are, of course, pros and cons with that. What's the downside of trying to be a YouTuber because it's easy to break into the market? Well, because it's easy to break into the market, there are millions of them out there, right? So you're competing with this vast amount of people on a type of business that anybody can break into with very little capital, very low threshold or barrier to entry. One of the big barriers to entry that are natural in even a capitalistic system, that not being the same as other systems, for example, like if we weren't in a capitalistic system, what's the big barrier to entry if you're in a communist system? The government, right? The government's not going to let you do business, right? If you start making money, they're going to come take it and beat you over the head, right? That's a barrier to entry. That's a problem. If you're in a capitalist system, you still have barriers to entry. Usually it's going to be the dollar amount that you need to break into a business. Some businesses having a bigger dollar amount than others. So if I'm doing, like, the reason, for example, Elon Musk has businesses that no one ever thought that he could ever do. It was thought that only the government could do those businesses, in part because of the mass capital investment involved. No one really thought you could just start up a new business to build cars with electronic batteries without maybe government assistance to break into the market to compete with people that were already in the market. No one really thought that you can compete with NASA, the massive, cost that it takes to build a rocket. And all that money didn't really come from him, but he was able to have enough trust apparently to get together the capital investments in order to make these things actually profitable without being government run, which is, again, a testament in my mind to the capital. That's like amazing. But but that's going to be a problem. Some things, like if you're on a farm, obviously you need the farmland and you need the equipment before you can use those things to start generating revenue. That's a huge capital investment. And that means that, for example, you could have the net value or equity in the business, which is fairly high, but you don't have any cash flows. You're still having problems paying your bills because all of your money is invested in rocket ships or in the land and the equipment for the farming that you're doing. You don't have any cash, even though you've got net assets that are quite high. So it depends on the industry in terms of how much. Now the question is, well, how are you going to get the money so you can break into the market so that you can start doing business? Well, one way is you can get equity investments. So if you were Elon Musk and you're going to start a rocket ship business, then how are you going to get that money? Not even Musk is that rich. He couldn't invest enough money to send rockets on his own, right? He's going to have to get some kind of capital investments. So he's either going to need money from other owners, possibly incorporating, right? And so that you can get owner capital. That's one of the major reasons that people incorporate if they can, because then they might be able to sell the stocks on a stock exchange and get investments, which comes with the problem of giving up ownership interest in the business at the same time, which makes it difficult to manage because now you have to deal with a bureaucratic system. So what's the other way that you can do it without giving up that ownership? Well, you could get a loan, say from the bank, for example. Now, on a small business side of things, because that's usually the market for QuickBooks, we're often starting as a sole proprietorship, right? And then we're going to grow. And then as we grow, we might want to invest in the business and grow in the business, buy a new store or something like that. Or we just can't handle the sales volume that we have. And so we have to hire more people. What are the options that we have in order to do that? We could either get the money in order to expand, again, by giving an equity interest, which might mean I go from a sole proprietorship to a partnership. But you have to be very careful of that, because now you're giving up equity interest, and the other person, now you have to make sure that you're on the same page, because if you deviate from the same page, then the business is in trouble because you have two different visions for two different owners of the business. So oftentimes small businesses start with a visionary who sees where they want to go, and if they lose control of guiding the ship, then it actually falls apart because other people have different ideas of what they're going to do, and their ideas are stupid or something. So you might want to keep if you have the idea, you might want to keep the track of how you're going to get there by maybe hiring employees or something like that, in which case you're going to have to pay them. How are you going to pay them? You can get a loan or something like that, right? So those are the two ways that we can kind of finance the business. We can put the money in ourselves. We can get equity investment, taking on partners or becoming incorporated, selling shares, or we can take on a loan from the bank. What's the problem with a loan from the bank? Well, the loan from the bank is great because the bank doesn't actually have ownership of your business, which again, I want to point out that there's a common misconception like that the bank owns the business, and it happens when people talk about their equity investment. Like if you own a home, for example, and I bought a $100,000 home and I have a $20,000 loan mortgage from the bank on the home, people will say that the bank owns 80% of the home. That's not exactly true. That's an overstatement. That's usually came from people trying to be modest, right? They're trying to say, yeah, I own a home, but the bank owns 80% of it. It's an overstatement. They don't really mean the bank owns 80% of it. What that means, because if the bank owned 80% of it, if they had a partnership interest in the home of 80%, the bank would be coming to your kitchen table and telling you what color they want the garage painted. And that's not what they do. They can't do that, right? They don't have any interest in the business. They can't tell you how to run the business unless you can't pay the bank. It's only when you can't pay the loan back according to the terms of the loan that the bank will suddenly be sitting at your kitchen table or your business table in the case of a business and telling you what to do, right? So there's a difference there. So the loan is good in that you don't have the bank in your business unless you can't pay the loan back plus interest, which is of course the downside. The purchasing power of the money, you have to pay back and pay rent on the purchasing power of the money, which is interest. All right, so let's take a look at these transactions. We'll just enter a couple transactions as though we're building up our equity that we're then going to use to buy our fixed assets to help us to generate revenue. So we'll start with a deposit from the owner. So if I hit like the plus button, the question when we enter our transactions is going to be, is this a transaction that happens all the time in our normal accounting cycle? If it were, then which form would I use within the accounting cycle? So if it was a revenue transaction, the form you would expect would be in this category. If it was an expense or money out transaction, the form would be in here. Problem here is this isn't normal. This isn't a transaction we expect to happen all the time. Me as the owner putting money into the business, taking it out of my personal checking account into the business doesn't happen all the time. There's not a form that's normal to do that because it should only happen when you start the business or grow the business. Otherwise, we expect the money to go the other way from the business to the owner in the form of a draw, or a corporation would have a dividend. Therefore, the next question is, well, is cash affected? Because if cash is affected, I can use either a decrease would be a check form or an increase a deposit form. And then if cash were not affected, then that and only then would I go to the journal entry form. So in this case, cash is affected. Is cash going up or down? It's going up. Therefore, I would think I would use the deposit form. So if I go into the deposit form, it looks like this. And I can enter the deposit using this form, but I don't usually like to use this form to enter a deposit unless I'm going to be entering the deposit with as I collect multiple payments on invoices or sales receipts, because otherwise I can enter it directly into the register, which would be a little bit easier. So if I close this out, the two other ways you can enter a deposit form, which are a little bit faster, is one, bank feeds, meaning if I, the owner, transferred money from my personal account into the bank account, then I might do that with an electronic transfer that would then flow through to the bank transactions in the bank feeds, which we'll see in a future course or section on bank feeds. And then when I record it over here from the bank feeds, I need to make sure that I record it as an owner investment and not as income, which most other deposits will be. I need to be able to recognize it. I have a system to recognize it as being distinct from income, because if I recorded it as income, I would be reporting income that I didn't earn, and that would be bad for taxes, right? That would increase my income, and I'd end up paying taxes on it. So that would not be good. I could then also, by the way, if you're a small business, you might be thinking, man, I'd really like to have a QuickBooks file for my personal bookkeeping, which you could do. You could set up two QuickBooks files, one for personal, one for business. Now, the problem with that is you'd have to pay for two QuickBooks files. If you're a small business, it's maybe you can have the same QuickBooks file for your small business and your personal self. Now, I say that hesitantly because people get mad at me when I say that, because most bookkeepers don't like that. And traditionally, you would like a separate QuickBooks system for those two things. However, if you had just a small sole proprietor business, you might be able to do that, right? And then you can differentiate the two accounts with the help and use of class tracking so that your income statement is broken out based on whether it's going to have two columns, business versus personal. And that's the income statement is all you really need for a small businesses to do the taxes, because that's what the Schedule C is going to be. So we have a whole nother course or section on that if you want to touch in on that, but we're going to imagine here that we're using QuickBooks just for business, keeping business totally separate from the personal. Our personal checking account, therefore, is not in the QuickBooks system. We're transferring from the personal checking account into the business checking account, keeping things as separate as we can. Let's go back on over here. And the other way we can do this is go into our chart of accounts and go into our register. So here's our checking account up top. I'm going to use the register to make the deposit. This is a little bit faster. So hit the drop down. I'm going to make a deposit type form. I'm going to say this happened as of 01/01/25. And then I could put myself as the payee, but I'm just going to leave it blank. I'm going to say this is owner investment as the memo, and I'm going to deposit. We're going to say it was $65,000. So I'm just imagining we put $65,000 in. Now, if there's an increase, again, what I really make sure don't do is put it to the income statement. It shouldn't be on the income statement. It needs to be some kind of equity account. I'm going to go through the list of accounts, which I wish were in order by account type, but they don't, because they try to, I don't know what they're trying to do. I don't know why they do it this way, but I'm looking for equity accounts here. So I'm scrolling down and look, they're trying to put the most used up top, I think, but here's the equity type of accounts, and here's owner investment. Now, in the equity accounts, remember that because I'm a sole proprietorship, the owner's equity is the same as like retained earnings for a corporation. That's what the income account's going to flow into. And then hopefully, normally we take money out of the business. When we take money out of the business because we generated revenue, we want to transfer it from the business to the personal, which is going to be more normal, hopefully going forward as we make money. We would use draws to take the money out. When we put money in, some people just put it into owner's equity, but I like to have a separate account for owner's investments. So that's an equity account. That's the important component. It's not an asset, even though it says investments. It's an equity account here. So that means if it's a sole proprietorship, you're going to have the retained earnings equivalent, owner's equity, draws for money pulled out by the owner investment for any money that's going to be put into the business. What would be the equivalent for a partnership? You would have, if you had 5 partners, you would have the same 3 accounts per partner, right? Partnership capital account, partnership draws, partnership, the one partner's equity for 5 partners. What if it was a corporation? The money going into the business comes from the issuance of stock. You issue the stock. That's why common stock is like the owner's investment. And then when they take the money out, it's going to be not called draws, but dividends, because everybody has to take the same amount out per share. And then the owner's equity would be called retained earnings. All right, so we're going to say owner investment, $65,000. So what will this do? It will increase the checking account by $65,000, the other side going into the equity account of owner investments. Let's save it and close it and then check it out. Go into the balance sheet, running to refresh it. And in the checking account, let's go into that checking account, checking out the checking. And within here, we have our deposit. Okay, that's right. There it is. Here's the beginning balance, and there's the deposit. $65,000. If I go into that, notice it takes me into the form. It doesn't take me back to the register. It takes me to the deposit form. So here's our deposit form. Boom. Looks good. I'm going to close this back out and go back. Where did the other side go? It went not to the income statement because it's not revenue, but it went into equity. So we've got owner investments, $65,000. There it is. There's the $65,000. Let's go back. Did anything happen to the income statement? run it to refresh it? No. Why? Because it wasn't income. It was a deposit, but we didn't get the deposit from customers. We got the deposit from the owner. Therefore, even though cash went up, the other side is still being represented as something that is owed to the owner, but not because we made a sale and earned it, but rather because the owner put it in there directly, and therefore the company owes it back to the owner. Now, again, obviously the company is not going to pay it back to the owner. The company is going to use the cash to buy equipment, which they're going to use the equipment to generate revenue. And then once we generate revenue, then hopefully we'll pay it back to the owner in the form of draws, which if it was a corporation would be dividends. All right, let's try the other one. The other way we can get money is to get it from the bank. So if we go to the bank and say, hey, look, we got this good idea, we need money. And if they believe in it, maybe they'll give us money. If they won't give us money, we can try to go elsewhere and see if other people will give us basically a loan and so on and so forth, right? But if we go to the bank, I'm going to say now we're going to get a loan from the bank. Let's go to the left. And once again, I could do this by hitting the plus button, entering a deposit form, or if I was in practice, then we might have the bank feeds on, and when the bank loans us the money, it would hit our checking account, and then we would record the deposit with the help and the use of the bank feeds. Sometimes when we get a loan, we might get the loan as we buy the equipment. So if you weren't to buy a forklift or a truck or something like that for the business, you might finance it as you purchase it. So in that case, you're basically taking on the financing of it, the loan, as you make the purchase. But we're going to take out the loan first and then purchase stuff with the money we get. So we're going to do it with, once again, the bank feeds. I'm going to hit the, as of January 2nd, let's say. And let's say we took it out from Chase. This is going to be the bank that we took it out from. So I'm going to add the vendor on the fly as we go, noting that QuickBooks only lets us add either vendors or customers. Normally when money goes out, it's a vendor. When money goes in, it's a customer. But as we saw before, we put money in and we're not a customer or a vendor. So that's not a perfect category. Chase, the bank, is not really a vendor because that's who we buy stuff from. They're the financer. So it's not really a perfect category to say that it's that the bank is a vendor, but that's the best we got, right? We got vendor, customer, and employee. So we're going to put them in as a vendor. I'm not going to add all the information. All I really need to do is to know who it is so I can sort my data by vendor. So I'm going to say save that. And then we're going to say this is going to be a loan, let's say. And let's say that it was a payment of, or a deposit of 50,000. Oh man, I should have put it in. I put it in as a vendor. I should have put it in as a customer. Well, it doesn't really matter either way because later we're going to be paying Chase for what we purchased. So I still think maybe vendor would be better. Even though this is a deposit, you might say it should be a customer. But I still think vendor is better because we're really purchasing financing and we're paying for it by giving them interest, right? We're going to pay for interest. So money's going up right now, but it's going to go down more over time as we pay it back plus interest. Now we're going to put the other side to a loan payable. So let's look at the balance sheet and see where should it go. It's not going to go to an expense, even though it's not going to go to income. Once again, make sure not to put it to income, even though money is going up. What we want to do is not put it to equity, but to loan payable. Now, a couple things just to point out here whenever we take on a loan. When we report the loan on like financial statements, we might not have to break it out if we're a small business because we might just be doing this for taxes, meaning we just need the income statement to help us to generate our tax return to create the Schedule C, which is basically an income statement. But if we have to make the balance sheet according to generally accepted accounting principles, as small businesses might need to do if they're regulated in some way and they get audited, or if they're trying to get a loan, then the loans should typically be broken out into a short-term and long-term portion of the loan. And so what does that mean? That means that the long-term liabilities are those that are going to be due after a year. Short-term liabilities are due within a year. Now, if we take a standard loan that is an installment loan, similar to what people are used to with like a mortgage, in which case we pay it off on a monthly basis, or with a car loan, similar kind of idea, we will often have a short-term portion and long-term portion, because part of the loan is going to be due within a year and part of the loan is going to be due after a year. And so that means we should have two accounts for reporting purposes for one loan, short-term versus long-term. However, you don't want to put it on the books that way for internal reporting purposes, because it's too tedious to try to break out the short-term and long-term portion of the loan every time you make a payment. That's ridiculous. So what we do instead is we would put it into one account, and then if we need to break out the short-term and long-term portions for reporting purposes, we do so at the end of the year as a type of adjusting entry in accordance, matching it then to the amortization tables. One other thing to point out, the loan payable, you might have multiple loans. If you're a construction company, then you might buy multiple pieces of equipment and have them as collateral for different loans, in which case you're going to have a bunch of loans, right? So do you group all the loans under one account or multiple accounts? I would suggest maybe you have a parent account called loans payable, and then you group all of the loans separately under each of those accounts. Why? Because that means that you can tie each of the loan balances out to the amortization tables as you make payments. So I would suggest that to be the general idea. I'm also going to put all of my loans as current loans, because most loans have a current portion to them and may not have a long-term portion to them. And it's not usually the other way around. But it doesn't really matter. You can imagine situations where it doesn't have a current portion, but you can make it long-term or short-term. I typically make them as a current liability, and then I break out the long-term portion as I need to periodically with an adjusting entry. Okay, also I have to point out that when you make payments on the loan, there's going to be an interest and principal component to it. And we'll see this later as we make the payments. The problem is that the interest and principal are not the same. The loan payment will be the same, but the amount allocated to interest and principal will differ, making it difficult to automate the system with the bank feeds. So we'll talk about different ways you might deal with that later. Also, if you get a complicated loan, like you're financing equipment, you possibly want to talk to your accountant on how best to enter that information into the system, and we'll talk about that later. But the general idea for financing is we're going to put the loan on the books, and I'm just going to put it here into loan payable. Loan payable for our purposes at this point. Current liability, boom, loan payable. So this is going to increase loan payable. The other side's just, and it's going to go to cash. Cash is going up, loan payable goes up. Let's go save it, and then go to the balance sheet and run it to refresh it. So now we see the checking account is going up. We've got the money that we can now use, hopefully, to buy stuff that we're going to then use to generate revenue. So there's going to be our loan. If I go into it, that takes us to our deposit form, closing that out. The other side went to the loan payable account. As we can see with the account, the type of form was a deposit form. Let's go back, check out the other side, which went into loan payable. Loan payable now at $72,000. Going into it, we see the $50,000 for loan payable. Looks good. If I go into that, there is our deposit form. Okay, closing that out and going back, making sure that the income statement still has nothing in it. Run it, nothing happening here because we didn't earn the revenue. We just took out a loan. We owe it back to the bank. We don't get to keep it. Okay, so now we of course, we've got the money to buy hopefully mainly fixed assets to help us to generate revenue, which is the next basically step in our plan before we can start doing our normal business activities. As a guitar seller, we're going to buy guitars so that we can then sell the guitars on the loans. We'll get into the idea of breaking out or how we're going to pay back the loans, breaking out the interest and principal later. And as we do that, we'll also make the amortization table, something oftentimes or possibly not always provided by the institution. So we can build the amortization table or talk to the accountant. And we'll also think about how we can automate the system to try to make it possibly using the bank feeds on a cash-based system, and maybe use your CPA firm or your accountant to shore things up. So just the idea at this point, when we put the loan on the books, is to try to think, how am I going to put the loan on the books? If I just had a bank fee transaction on a cash-based system, the cash would have hit the bank, and therefore I would record it as a loan when it hit the bank. But what if I financed equipment or something and I had to put down a down payment and then cash was affected and maybe there was a trade-in or something like that? Then at that time, you might still just say, hey, look, I'm going to rely on my accountant. So you might call the accountant and say, give me the journal entry, help me to figure this out. How should I put this on the books? But with that complicated of a transaction, it often is going to be a mess no matter what, because if you traded in a piece of equipment or something like that, it's going to involve the depreciation schedules, which might not be finalized anyways because they're going to come from the tax return. So sometimes it's actually easier to just say, hey, look, I'm just going to record the cash side, the deposit that I made on it, and then I'm going to basically record the loan payments that I make going forward into the loan account so I can see that there is a loan there. And I'm going to tell my accountant, this is the complex transaction. I paid for this. I show the deposit in the account right here. And then I have my loan schedule or my loan paperwork and with the trade-in. And what I would like you to do is basically set up the loan account, make the amortization schedule, record the transaction properly to record the purchase of the equipment, the trade-in of the equipment, the amortization of the equipment, and then break out the short-term and long-term portion of the loan as of the end of the year, if necessary, and break out the interest portion, properly allocating the amount of payments going to interest versus principal. They're going to have to do that anyways, oftentimes. So it's almost easier to just say, I'm just going to be on a cash-based system, but I'm going to make sure I have the documentation to tell the accountant to then fix that transaction based on the loan paperwork, the sales paperwork, the trade-in paperwork, the amortization table, and the depreciation tables, right? So as long as you communicate that well, that could be the easiest way to go. In any case.